Known as the Oracle of Omaha for his track record of picking winning investments, Buffett is joined by his right-hand man Charlie Munger, vice chairman of Berkshire. The duo is sharing their unscripted views on their company, the financial markets, the economy, politics, corporate governance, and investing. Their comments on the near term have been known to move markets. Their insights on the long term have earned fortunes for investors. We're covering the Berkshire Hathaway annual shareholder meeting live on this page, so hit refresh or click here for the latest updates. The meeting kicked off with Buffett delving into the current state of Berkshire and its recent performance. First and foremost, Buffett decried a new accounting rule that has been making a mess of Berkshire's net earnings. Specifically, the rule forced companies to mark-to-market the value of their stock portfolios. And Berkshire's portfolio is massive, which has caused wild swings in earnings. That said, Berkshire reported modest growth in its quarterly operating earnings. Second, Buffett and Munger addressed stock buybacks. During the first quarter, Berkshire repurchased $1.7 billion worth of Class A and B shares. This comes as the M&A options remain unattractive. "We're going to probably be more liberal when it comes to repurchasing shares," Munger said. "In the years ahead, we hope to move much of our excess liquidity into businesses that Berkshire will permanently own," Buffett said in his 2018 letter to shareholders. The immediate prospects for that, however, are not good. Prices are sky high for businesses possessing decent long-term prospects. For now, Berkshire's cash hoard continues to grow. As of the end of Q1, the company was sitting on $114.2 billion, up from $111.9 billion at the end of Q4. "We are certainly willing to spend $100 billion on buybacks," Buffett said, should Berkshire's market value falls below intrinsic value. Wells Fargo continues to recover from its fake account scandal, which the world first learned about in September 2016. The bank admitted that employees had created millions of accounts for clients without their permission. Wells' woes led to the departure of CEO John Stumpf in 2016 and more recently Tim Sloan in 2019, who took over for Stumpf. Some have called for jailing Wells' top executives including CEOs. Buffett and Munger disagree. "It looks to me like Wells made some big mistakes in what they incentivized," Buffett said. "I've seen that at a lot of places. That clearly existed at Wells. To the extent that they set up fake accounts, a couple of million of them that had no balance in them, that could not possibly have been profitable to Wells. While the top execs were responsible for the incentives, they should not be responsible of the acts those incentives incentivized," Buffett and Munger argue. "I don't think people ought to go to jail for honest errors of judgment. It's bad enough to lose your job," Munger said. "I wish Tim Sloan was still there." News was breaking even before the meeting started. On the Thursday ahead of the meeting, Buffett told CNBC's Becky Quick that Berkshire had amassed a new position in Amazon, AMZN. He attributed the purchase to one of the fellows in the office that manage money. In other words, the decision was made by Todd Combs or Ted Weschler. Over the past decade, Warren Buffett has been slowly taking a step back from his responsibilities at his company. Specifically, he hired two younger money managers, Todd Combs in 2010 and Ted Weschler in 2011, to eventually run Berkshire's massive investment portfolio. It's worth noting that Buffett has acknowledged missing Amazon was a mistake. On Friday, Buffett and Munger shared some thoughts on marijuana in response to a question from Fox Business Network's Liz Clayman. "It would be a mistake for Coca-Cola, KO, to get into the marijuana cannabis business," they reportedly said to Clayman. "They have a wholesome image and that would be detrimental to it. Our chairman and CEO, James Quincy, has repeatedly stated we don't have plans to get into this space," a Coca-Cola spokesperson said to News Pulse Finance. Coca-Cola is arguably the most successful investment Berkshire ever made. Buffett, 88, first invested in a Berkshire Hathaway, a failing textile company, back in December 1962, accumulating 7% of the company at $1 per share. The company was owned by a man named C. Barry Stanton, who in 1964 asked Buffett for the price he'd be willing to sell his stake. Buffett said $1, and they had a deal. However, Stanton later turned around and made a tender offer to shareholders for $1 per share. Buffett didn't care for that behavior, so he ended up hanging on. "That was a monumentally stupid decision," Buffett said in his 2014 letter to shareholders. Irritated by Stanton's chiseling, I ignored his offer and began to aggressively buy more Berkshire shares. Click here for full coverage of the 2019 Berkshire Hathaway shareholders meeting. Buffett took control of the company in May of 1965. And that was followed by another 2 decades of tough lessons. During the 18 years following 1966, we struggled unremittingly with the textile business, all to no avail, he said. But stupidity, has its limits. In 1985, I finally threw in the towel and closed the operation. Despite his great success and status, Buffett's career is riddled with failures. Ultimately, his real triumph is learning from his mistakes to eventually seal his legacy as the world's greatest investor. Sam Ro is managing editor at Newspulse Finance. Follow him on Twitter, at Sam Ro. Follow Newspulse Finance on Twitter, Facebook, Instagram, Flipboard, Smart News, LinkedIn, YouTube, and Reddit.